How's it going, YouTube? I'm Ari, and welcome back to Blue Lion Finance, a channel dedicated to investing, which if you are brand new to the Blue Lion Finance channel, I created for all of you to simply follow my financial journey as I dollar cost average my way into my investments throughout the ups and the downs of the market swings. Now, initially, I started my journey back in 2019 with $3,000 invested into a Vanguard index fund before building a dividend investment portfolio, which is now sitting at $80,989.82, down considerably from my record high just weeks before of around $93,000, all before the volatility. Now, I hate to be the I told you so guy, but just going back to a video of mine last week prior to the Federal Reserve's chess move of a 75 basis point rate hike, I said, recognize this week will be quite a roller coaster ride, proceed with long-term optimism, and embrace this time to buy discounted stocks. And a roller coaster ride it has certainly been, with all three major indexes down from the S&P, Dow, and NASDAQ booking their third straight week of losses, and the S&P actually experiencing its worst weekly percentage drop since March of 2020. My take: the volatility is really just beginning to ramp up, and a recession seems more likely by the day. But the investment decisions we make now will ultimately determine our wealth come the next bull run. So in today's video, I want to get to talking about 5 dividend stocks that I continue to personally double down on as the market continues to spiral. Just before we get going, make sure you tap on that thumbs up button and help me grow this channel and get the word out there. If you haven't already subscribed, make your way over to doing so. I'd love for each and every one of you to be on this journey with me. Now, YouTube, let's go ahead and dive right in. So prior to the latest inflationary report, analysts were prepared for a 50 basis point interest rate hike to cool boiling inflation, but inflation popped to 8.6%. The Federal Reserve followed up with a more aggressive rate hike and 75 basis points higher. We are now seeing all-out panic as investors weigh the probability of a recession. However, as a long-term dividend investor, I see this period as an opportune time to simply buy heavily discounted value stocks at fair or discounted prices. This all leads me to the stocks that I've been doubling down on. The first stock on my list is Apple, ticker symbol AAPL, which I'm going to safely assume doesn't need an introduction. So I'm going to jump to it and sharing exactly why I am so bullish on Apple and why it has become such a significant portion of my portfolio, roughly 17% of it, which I would like to inflate all the way up to around 20% worth of my portfolio. Right off the bat, Apple is the world's most valuable company with a market capitalization sitting at $2.13 trillion, which speaks volumes in my opinion in regards to its safety as an investment. Now, Apple has truly become an iconic tech titan, asserting their dominance on a global scale and without much competition. The way I see it, if you're an Apple product user, you're not going to be likely deviating from it anytime soon. It is certainly that brand loyalty that makes Apple such a fantastic investment. Apple hasn't lost much steam since the early 2000s in terms of raking in revenue, and a matter of fact, their net sales increased by 8.6% from the prior year to $97.28 billion, which helped the stock share price gain around 3.6% over the last year. However, with the recent volatility, Apple stock is down from its 52-week high of around $182, trading now for around $131, making for a 28% discount opportunity if you ask me. Yes, I could see their PE ratio coming down just a tad more for it to be a better buy. It is coming in at 21.38. Products are coming down the pipeline, specifically their virtual reality headset to be released in 2023 that will help launch us into a new technology era. And come 2025, the Apple Car will be released, hitting the streets, which in my opinion is going to be the only major competitor for Tesla. Now, I don't foresee their current product line from iPhone to Mac or iPad, wearables and services losing any steam either, but rather continuing to drive the market, making for a very promising future once an economic turnaround is underway, which analysts also firmly believe is to come, as they have priced Apple at a median share price of $190 per share and a high stock share price of $219.94 per share. So I went ahead to pick up 2 more shares worth of Apple for $262.14, bringing my share count of Apple up to 112 shares. And until Apple's come back, I'll happily collect on Apple's dividend with a current dividend yield at 0.7%. Moving to my second stock in focus as the market tanks, let's talk about Johnson & Johnson, ticker symbol J&J. Again, another industry leader and a dividend portfolio must-have in my opinion. After Johnson & Johnson's founding in 1886, Johnson & Johnson created a range of medical products for doctors. However, over their 130-year history, they have expanded their product range significantly through 3 segments: pharmaceuticals, medical devices, and health and beauty products, resulting in some pretty prominent brand names like Tylenol, Band-Aid, Neutrogena, Aveeno. And Johnson & Johnson has also begun to develop leading industry drugs taking on some of the world's most serious conditions, from diabetes to cancer, which all speaks to their moat worth of diversification. Now, I can go on and on about their products, but the real evidence of their success is found within their balance sheet. Just in 2021 alone, Johnson & Johnson brought in $93 billion and continues to claim a top spot in the top 10 most valuable companies in the world by market capitalization. Their current market cap is sitting at just over $445 billion. And given Johnson & Johnson's business model, it's not only a phenomenal stock to own when the markets are calm, but even more so of a hold amidst market volatility and a looming recession ahead. If we think about the fundamental impact of a recession, consumer spending decreases with the luxury and unnecessary items being removed from a shopping list, but Tylenol, diapers, diabetes, cancer treatments, not a shot. So the demand for Johnson & Johnson products creates one heck of a resistant investment to volatility in the broader economy. And even though it fell from a 52-week high of $186 to $169, making for a 9% change, analysts foresee a smooth recovery and growth ahead, driving their median stock share price to $187 per share and a high stock share price of $215 per share. In regards to their PE ratio, it too could come down a bit, but there is a premium to be paid for a quality stock like Johnson & Johnson. In my opinion, that premium is worth it. Their PE ratio is coming in at 22.83. I went ahead to scoop up 2 more shares this past week for $170.08, raising my share count of Johnson & Johnson to 48 total shares. Now, I will collect on Johnson & Johnson's dividend at 2.67%. As for my third stock in focus, we are talking about Stag Industrial, ticker symbol STAG, which is a real estate investment trust that was founded not too long ago in 2010 and primarily focused on single-tenant industrial properties like warehouses and distribution centers, which is key, so keep that in mind as we go. But before I get going into more detail about Stag Industrial, this is a great plug to share that REITs are a phenomenal investment to park your cash during high inflationary periods, as physical assets tend to appreciate in value as cost of living goes up. So back to Stag Industrial and why Stag Industrial is a position I am focused on growing right now. Well, simply put, Stag Industrial is a powerhouse, having amassed a portfolio of 551 properties across 40 states, with their strategy of acquiring and leasing out properties in secondary markets, resulting in a market capitalization at $5.44 billion, which is impressive for such a young REIT. And in regards to their safety, Stag Industrial maintains a high 97% portfolio occupancy with reliable tenants, having leased their properties, tenants like Amazon and FedEx, that should only continue to strengthen relations with Stag Industrial as we move into more of an e-commerce future. Of course, Stag Industrial has been shaken by the stock market mayhem as well, coming down from a 52-week high of around $48 per share, dropping to $30 per share, making for a whopping 38% change, which screams opportunity to me, especially with analysts predicting a smooth recovery and continued growth well into their future, with a median stock share price at $43 per share and a high stock share price at $54 per share. Now, I snagged another share of Stag Industrial for $30.57, bringing my total share count of Stag Industrial to 29 total shares. It is a monthly dividend paying stock. As we anticipate this economic turnaround, we'll collect on that dividend of theirs at 4.81%. Jumping to our fourth stock that I am eager to buy more shares of should it actually drop more in a stock share price, we're talking about Coca-Cola, ticker symbol KO. Again, just another industry leader in its own right that needs little to no explanation, as it's the world's dominant soft drink manufacturer. What many of you may or may not know is that Coca-Cola has over 500 brands worldwide and operates in over 200 countries. Since its founding in 1886, Coca-Cola has not let up on an ambitious goal of being, well, just about everywhere and anywhere, which has allowed their market capitalization to balloon to over $257 billion. Now, initially, I began building my position with Coca-Cola back in March of 2020, and since then, my only real regret has been not buying more. Sure, Coca-Cola may not be as exciting as, say, a startup or a tech giant, but oftentimes those quote-unquote boring investments are more lucrative, which is exactly how I view Coca-Cola. Purely from a marketing perspective, Coca-Cola Coca-Cola's iconic name, along with their successful branding around each beverage, in addition to their distributor network and retail relationships, protects it all from competition, which helps Coca-Cola weather market volatility and results in strong financial performance, evidenced within their quarterly earnings report year-over-year growth despite all of the market conditions. Case in point, Coca-Cola was hardly rocked by the recent volatility, with their stock falling from a high of $67 per share to $59 per share, which is about a 13% change, and hopefully more of a decline to come. Their PE ratio is currently sitting at 25.07, but perhaps Buffett's advice comes in handy here, and that it is far better to buy wonderful companies at fair prices as opposed to fair companies at wonderful prices. Not to mention, Coca-Cola is one of Buffett's oldest and largest investments within the Berkshire Hathaway portfolio. Looking ahead, analysts foresee more growth just after its rebound, with a median stock share price coming up to $70 per share and a high stock share price coming all the way up to $76 per share. Now again, I will be more aggressive with my Coca-Cola position if the stock itself really tanks, but for now I did add another share this past week of the soft drink behemoth for $58.93, bringing my portfolio total to 18 total shares. In the meantime, before its comeback, I'll collect happily on Coca-Cola's dividend, with their current dividend yield coming in at 2.96%. Last but certainly not least, I will continue to double down, as I always do, on Vanguard's Total Stock Market Index Fund, ticker symbol VTI, by way of dollar cost averaging into the fund, which is what I deem a fail-safe strategy for a long-term win. An investment into VTI allows an investor to really take advantage of the entire market, with just one share being an investment into over 4,000 stocks from small to mid and large caps, with a great balance and mixture of both growth and value investments. I'm talking about stocks like Apple, Microsoft, Amazon, Google, Tesla, Berkshire Hathaway, Johnson & Johnson, United Health, all investments that you certainly cannot go wrong with. And given it tracks the market and the market is down, it's roughly down by 25%, falling from $244 a share to around $183 per share, making for a fail-safe investment that you should definitely be thinking about making right now. Now YouTube, that is it from Apple to Johnson & Johnson, Stag Industrial to Coca-Cola, and Vanguard's Total Stock Market Index Fund. I spent $704.18 this past week. As the market continues to spiral, I am definitely going to continue to dollar cost average my way into these positions along with some others, but I'd certainly love to know which stocks you have your eyes on, which ones you're currently investing in, or if you're even holding off from investing at all. Drop a comment or two below and let me know. Keep in mind that I'm not a financial advisor, so always just do your due diligence after watching my videos, but do go ahead and tap on that thumbs up button, as it greatly helps me out in growing this channel. If you haven't already subscribed, make your way over to doing so. I'd love to have each and every one of you on this journey with me. Now YouTube, until the next video, I will see you all there.